Imagine two investors who started with $10,000 30 years ago. The first one, let us call him Isaac Hamilton, spent countless hours researching stocks, timing market entries, and actively managing his portfolio. He paid an average of 2% annually in fees, commissions, and taxes from frequent trading. The second investor, Karen Greene, invested her entire sum in low-cost index funds and essentially forgot about it, paying just 0.05% in annual fees. Today, Isaac's account shows $132,000. Impressive, perhaps, until you look at Karen's balance, $364,000. That is a difference of $232,000, enough to purchase a house in many American cities, from the exact same starting investment. Did Karen possess some extraordinary investment talent? Did she have privileged information or exceptional market timing abilities? No. She simply understood what most Wall Street professionals hope you never discover: the astonishing power of low-cost index investing combined with specific optimization techniques that almost seem too simple to work. The greatest enemy of a good plan is the dream of a perfect plan, said economist John Bogle, who revolutionized investing for everyday Americans. What if the complicated investment strategies many financial advisors sell are actually designed to generate fees rather than results? What if the most sophisticated investment approach is also the most straightforward? This might be why Warren Buffett instructed the trustee of his estate to invest 90% of his wealth in a simple S&P 500 index fund for his wife after his death. The man who made billions through active investing is telling those he loves most to use passive index funds. Why? To understand why index funds represent such a revolutionary approach to wealth building, we must first understand the traditional investment landscape most Americans navigate. For decades, the financial services industry has operated on a simple premise: investing is complicated, markets are dangerous, and you need expert guidance to navigate them successfully. This premise has generated trillions in management fees, commissions, and other expenses that silently drain investment accounts across the country. Consider this: the average actively managed mutual fund charges approximately 1.5% in annual expenses. This might seem trivial, just 1.5 pennies per dollar invested, but the long-term impact is staggering. On a $100,000 investment over 30 years, this seemingly small percentage can reduce your final balance by over $200,000, assuming historical market returns. Let us examine how this happens through the story of two typical American families. The Ramirez family trusted their financial future to a well-dressed advisor at a prestigious firm who promised to beat the market with sophisticated strategies. Their portfolio included a selection of actively managed mutual funds with an average expense ratio of 1.3%, plus quarterly management fees of 0.75%. The Johnson family, after reading a few investment books, opened accounts at a low-cost broker and invested in broad market index funds charging just 0.04% annually. No advisor fees, no commissions, no performance bonuses. After 25 years, despite both families investing identical amounts and the underlying markets delivering the same returns, the Johnsons had accumulated 33% more wealth. The difference came entirely from costs, not investment performance. This reality reflects a profound truth first articulated by Nobel Prize-winning economist William Sharpe. After costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. This mathematical certainty stems from a simple fact: all investors collectively own the entire market. Active investors, trying to outperform by buying and selling frequently, must collectively match the market's return before costs. After deducting their substantially higher costs, they must underperform in aggregate. Princeton professor Burton Malkiel put it even more bluntly in his classic book, A Random Walk Down Wall Street. A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Yet, despite this compelling evidence, Americans still entrust approximately $11 trillion to actively managed mutual funds. Why? Because the financial industry spends billions on marketing designed to create the illusion of expertise and the promise of market-beating returns. The birth of index funds in the 1970s offered a radical alternative. Rather than trying to pick winning stocks or time market movements, Index funds simply own everything in a specified market at the lowest possible cost. John Bogle launched the first publicly available index fund in 1976, despite Wall Street labeling it un-American and a sure path to mediocrity. 5 decades later, index investing has grown from a ridiculed concept to a $10 trillion movement, with Vanguard alone managing over $7 trillion in assets. But here is where our story takes an intriguing turn. What if standard index investing is just the beginning? What if there are specific hacks that can enhance even this revolutionary approach? Before we explore these optimization strategies, we must first ask, if index investing is so effective, why isn't everyone doing it? And more importantly, what overlooked techniques could push your results even further? The superiority of index investing rests on overwhelming academic evidence. Studies spanning decades consistently show that 80 to 90% of active managers underperform their benchmark indexes over extended periods. This isn't just true in efficient markets like large U.S. stocks. It applies to nearly every investment category, from small companies to international markets and even bonds. Yet, despite this mountain of evidence, millions of investors continue following active strategies. The disconnect between evidence and behavior constitutes what economists call the behavior gap. The difference between what markets actually return and what typical investors earn. This gap exists because humans are not wired for successful investing. Our brains evolved to detect patterns, respond to threats, and seek status, traits that worked well on the African savanna but create disaster in financial markets. We panic and sell during crashes. We chase performance after markets have already risen. We confuse randomness with skill when evaluating investment managers. Consider the curious case of the Fidelity Magellan Fund under legendary manager Peter Lynch. From 1977 to 1990, Lynch delivered astonishing 29% annual returns, more than doubling the market average. An investment of $10,000 would have grown to over $280,000 during his tenure, a remarkable achievement by any standard. Yet, according to Fidelity's own analysis, the average investor in the fund actually lost money during this period. How is this mathematically possible? Because investors poured money in after periods of strong performance and withdrew it after inevitable declines, buying high and selling low with devastating consistency. This self-destructive pattern reveals an uncomfortable truth. Investment success depends less on which funds you choose and more on how you behave with those investments. The greatest advantage of index funds isn't just their low costs. It's that their boring, unsexy nature makes them easier to hold through market turbulence. But here is where our first index fund hack emerges. What if you could combine the proven advantages of index investing with strategies that protect you from your own worst behavioral tendencies? Meet Ian Hughes, a 42-year-old software engineer from Denver. In 2008, as markets plummeted during the financial crisis, Ian watched his 401k balance drop by 45%. Panicked, he sold everything and moved to cash, just weeks before the market bottomed and began its historic bull run. This catastrophic timing decision cost him over $380,000 in future gains based on his account size. After this expensive lesson, Ian restructured his approach. He still used index funds exclusively, but implemented what behavioral economists call commitment devices, structural changes that protect us from future irrational behavior. He 1. Automated all investment contributions. 2. Limited portfolio checking to once quarterly. 3. Pre-wrote an investment policy statement detailing exactly how he would respond to market drops. 4. Established a permission wall requiring him to discuss any portfolio changes with his financial accountability partner before execution during the March 2020 COVID crash. When markets plunged 34% in record time, Ian's system protected him from repeating his 2008 mistake. He not only stayed invested but increased his contributions, actions that added approximately $217,000 to his current portfolio value compared to if he had panicked again. This behavioral approach to index investing represents our first hack, using systems and structures to enhance returns without changing the underlying investment strategy. Research from Vanguard suggests this behavioral coaching component alone can add approximately 1.5% annually to investor returns, more than any other single optimization technique. But what about the investments themselves? Are all index funds created equal? The answer leads us to our second major revelation. Significant performance differences exist even within the supposedly passive index world, and understanding these distinctions can dramatically impact your results. Consider 3 investors who decided to invest in the market through S&P 500 index funds in 2010. Investor A chose the RIDEX S&P 500 fund, RISOX, with a 1.55% expense ratio. Investor B selected the Vanguard S&P 500 ETF VOO with a 0.03% expense ratio. Investor C purchased the Invesco S&P 500 Equal Weight ETF RSP, tracking the same companies but with equal allocations to each, with a 0.2% expense ratio. By 2023. Their identical $100,000 investments had grown to remarkably different amounts. Investor A, $423,000. Investor B, $479,000. Investor C, $501,000. These dramatic differences emerge from 2 critical factors: costs and construction methodology. The first is obvious: lower expenses translate directly to higher returns. But the second factor reveals something more profound. The way an index is constructed significantly impacts performance. Most popular index funds weight companies by market capitalization, meaning larger companies comprise a greater percentage of the fund. The S&P 500, for instance, doesn't give equal weight to all 500 companies. The top 10 stocks currently represent over 30% of the entire index, while the bottom 100 collectively account for less than 3%. This concentration creates both opportunities and risks. During periods when large companies outperform, cap-weighted indexes deliver superior returns. But during periods favoring smaller companies, equal-weighted or alternative indexing methods often prevail. This insight unlocks our second major hack: strategic diversification across indexing methodologies, not just across asset classes. Catherine Gonzalez, a 37-year-old pharmacist from Charlotte, applied this principle after discovering that different indexing approaches captured different factors, fundamental characteristics that academic research has linked to higher expected returns. Rather than simply buying the standard S&P 500 index fund, Catherine constructed a portfolio allocating 50% to traditional market cap weighted index funds, capturing the entire market efficiently, 30% to value-tilted index funds, focusing on undervalued companies, 20% to small-cap index funds, capturing the historical outperformance of smaller companies, all still index funds, all still low-cost, but structured to potentially enhance returns by systematically capturing these researched factors. The results? While a standard index portfolio would have returned approximately 13.6% annually over the past decade, Catherine's factor-tilted approach generated 15.1%, a seemingly small difference that increased her ending balance by over $31,000 on her initial $100,000 investment. But here is where our mystery deepens further. If these optimization techniques are so effective, why do they remain relatively unknown to most investors? And what other hidden hacks might exist within the index investing framework? The answer lies partly in the financial industry's incentive structure. Traditional financial advisors earn little or nothing from recommending simple, low-cost index solutions. The industry's profitability depends on complexity, activity, and opacity, precisely what index investing eliminates. This brings us to perhaps the most powerful index fund hack of all: tax optimization strategies that can dramatically enhance after-tax returns without increasing risk or complexity. Consider this startling fact. For most American investors in higher tax brackets, taxes represent a larger drag on investment returns than all other expenses combined. Studies from Morningstar and Vanguard suggest that tax-inefficient investment approaches can reduce returns by 1 to 2% annually, potentially cutting your retirement balance by 20 to 40% over a typical accumulation period. Yet, remarkably few investors implement systematic tax optimization strategies with their index portfolios. Those who do gain an almost unfair advantage, legally keeping thousands, sometimes millions, more of their investment returns. Isaac Hamilton, a 53-year-old college professor, discovered this principle after a casual conversation with a colleague in his university's finance department. Using only index funds but implementing systematic tax management techniques, Isaac 1. Placed high-growth index funds in Roth accounts to capture tax-free appreciation. 2. Positioned income-generating indexes in tax-deferred accounts to postpone taxation. 3. Utilized tax loss harvesting during market declines to offset other income. 4. Implemented a tax-aware withdrawal strategy for retirement. The impact. Based on his portfolio size and tax bracket, these techniques are projected to preserve an additional $843,000 in wealth over his lifetime compared to a tax-oblivious approach, despite using identical underlying index investments. I was shocked, Isaac recounted. I had spent years comparing expense ratios down to the 100th%, saving perhaps a few $100s annually. Meanwhile, I was losing tens of thousands yearly to preventable taxation simply because I didn't understand how to structure my accounts properly. This revelation leads us to a profound question. What other optimization techniques might be hiding in plain sight, available to index investors willing to look beyond the basic advice to buy and hold low-cost funds? The true power of index investing emerges not from merely buying market-tracking funds, but from systematically optimizing around them. The most sophisticated investors understand that index funds provide an unparalleled foundation, but the real magic happens in how you implement, enhance, and protect this core strategy. Let us examine the 7 most powerful index fund hacks that can potentially transform your financial future. Hack number 1. Strategic asset location. The typical advice to diversify your investments addresses what you own, but sophisticated index investors also optimize where those investments are held. This strategy, called asset location, can add up to 0.75% annually to your after-tax returns according to Vanguard research. The principle is straightforward. Place tax-inefficient investments in tax-advantaged accounts and tax-efficient investments in taxable accounts. Specifically, position bond index funds, REITs, and high-turnover indexes in tax-advantaged accounts, 401(k)s, IRAs. Place tax-efficient investments like total market stock index funds in taxable accounts. Reserve Roth accounts for assets with the highest growth potential. Catherine Gonzalez implemented this strategy after calculating she was losing approximately $4,700 annually to tax inefficiency despite using exclusively low-cost index funds. By systematically relocating her index funds across account types without changing her overall allocation, she projects an additional $317,000 in retirement wealth, a staggering improvement from a zero-cost adjustment. Hack number 2. Systematic tax loss harvesting. While traditional index advice often emphasizes buy and hold, sophisticated practitioners recognize that market volatility creates tax optimization opportunities without abandoning the indexing approach. Tax loss harvesting, selling investments that have declined in value to realize tax losses while maintaining market exposure, can add between 0.2% and 1.1% annually to after-tax returns according to research from Betterment and Wealthfront. The strategy works like this. 1. When an index fund declines in value, sell it to realize the loss. 2. Immediately purchase a similar but not identical index fund to maintain market exposure. 3. Use the realized losses to offset capital gains or up to $3,000 in ordinary income annually. 4. Carry forward any excess losses to future tax years. Important to note, this strategy typically requires a taxable account with sufficient assets, usually $50,000 plus, to generate meaningful benefits. Ian Hughes implemented systematic tax loss harvesting during the 2020 market crash, capturing approximately $27,000 in tax losses within 2 weeks. These losses not only offset capital gains from other investments but provided $3,000 annual deductions against his ordinary income for the next 8 years. The estimated lifetime value of this single period of harvesting exceeds $51,000 in tax savings, all while maintaining his desired market exposure through similar index funds. Hack number 3. Factor tilting for enhanced returns. Decades of academic research have identified specific factors, characteristics of stocks associated with higher expected returns over time. The most robust include value. Undervalued companies tend to outperform. Size. Smaller companies historically deliver higher returns. Quality, profitable companies with stable earnings outperform. Momentum, stocks that have performed well recently often continue outperforming. While traditional index funds provide broad market exposure, sophisticated investors often tilt their portfolios toward these factors using specialized index funds, potentially enhancing returns without abandoning the passive approach. Karen Greene implemented a factor-tilted portfolio after discovering that historically, these factors had added approximately 1 to 2% annually to returns compared to standard market cap weighted indexes. Rather than speculating on individual stocks, she simply allocated portions of her portfolio to factor-focused index funds, 50% to traditional total market index funds, VTI, 20% to value index funds, VOV, 15% to small-cap value index funds, VBR, 15% to quality-focused index funds, QUAL, all still passive, all still low-cost, but positioned to potentially capture the premiums these factors have historically provided. The approach increased her annual returns by approximately 1.3% over the past decade compared to a standard index portfolio, translating to an additional $192,000 on her portfolio. Hack number 4. Direct indexing, the future of personalized passive investing. Perhaps the most revolutionary development in the indexing world is the emergence of direct indexing, owning the individual components of an index rather than a fund, enabling unprecedented tax efficiency and customization while maintaining the core benefits of passive exposure. Traditionally available only to ultra-wealthy investors with millions to invest, new platforms like Wealthfront, Parametric, and Fidelity's personalized indexing have democratized this approach for investors with as little as $100,000 in assets. Direct indexing offers 3 primary advantages. 1. Enhanced tax loss harvesting at the individual stock level. 2. Customization to accommodate existing concentrated positions. 3. Values-based exclusions without sacrificing broad market exposure. Research from Morgan Stanley suggests direct indexing can add 1% to 2.0% in annual after-tax returns compared to traditional index funds through more granular tax management alone. Isaac Hamilton adopted direct indexing for his taxable accounts after inheriting a significant position in his former employer's stock that he couldn't immediately liquidate for tax reasons. Through direct indexing, he 1. Built a personalized S&P 500 index excluding his concentrated position. 2. Harvested losses at the individual stock level during normal market volatility. 3. Gradually reduced his concentrated position through charitable giving of appreciated shares. 4. Excluded specific companies that conflicted with his ethical values. The approach generated an estimated $14,300 in additional annual tax alpha compared to using traditional index ETFs, without changing his underlying market exposure or increasing his overall risk profile. Hack number 5. Risk factor diversification. Traditional portfolio construction focuses on asset class diversification, stocks versus bonds versus alternatives. Sophisticated index investors, however, increasingly diversify across risk factors instead. This approach recognizes that seemingly different asset classes often share underlying risk exposures. For instance, stocks and high-yield bonds both carry significant exposure to economic growth risk. A portfolio 60% in stocks and 40% in high-yield bonds appears diversified by asset class but remains heavily concentrated in growth risk. True diversification requires spreading exposure across fundamental risk factors: growth risk, economic expansion; inflation risk, rising prices; interest rate risk, changing rates; liquidity risk, access to cash. Catherine Gonzalez restructured her index portfolio to diversify across these risk factors rather than traditional asset classes: growth risk, total stock market index funds; inflation risk, Treasury inflation-protected securities, TIPS, and commodity index funds; interest rate risk, short-term bond index funds; liquidity premium, small allocations to real estate and infrastructure index funds. This risk factor approach provided more consistent returns during market stress periods. During the inflation spike of 2022, when both stocks and bonds declined simultaneously, her portfolio outperformed a traditional 60-40 allocation by 7.4 percentage points, preserving tens of thousands in wealth during a challenging market environment. Hack number 6. The glide path optimization. Most target date index funds follow a predetermined glide path, automatically reducing stock exposure as you approach retirement. While convenient, this one-size-fits-all approach ignores your unique circumstances. Research from financial planner Michael Kitces suggests that the standard approach, progressively reducing equity exposure as you age, may actually increase rather than decrease retirement risks for many investors. The optimization hack? Creating a personalized glide path based on your specific situation. 1. Higher equity allocations during the 5 to 10 years before retirement, when your portfolio is largest and sequence risk still manageable. 2. Temporarily lower equity exposure in the first 5 to 10 years of retirement, when sequence risk is highest. 3. Increasing equity exposure in later retirement years to address longevity risk. Ian Hughes implemented this bond-tense strategy approaching retirement, temporarily increasing his bond allocation to 50% at retirement, then gradually reducing it back to 30% over 10 years. Backtesting suggests this approach would have increased portfolio survivability by 14% during historical period analysis compared to a traditional glide path, while still using only standard index funds for implementation. Hack number 7. The withdrawal strategy revolution. Perhaps the most overlooked aspect of index investing relates not to accumulation but distribution. How you withdraw funds during retirement can dramatically impact longevity. The conventional 4% rule approach suggests withdrawing 4% of your initial balance annually, adjusted for inflation. But sophisticated index investors implement more nuanced strategies that can potentially extend portfolio life by 5 to 10 years or increase sustainable withdrawal rates by 0.5 to 1.5% annually. 1. Dynamic withdrawal strategies that adjust spending based on portfolio performance. 2. Reserve buffer approaches that reduce withdrawals during market downturns. 3. Time segmentation strategies that match investment horizons with withdrawal timeframes. 4. Tax-optimal withdrawal sequencing across account types. Karen Greene implemented a dynamic withdrawal strategy with her index portfolio, adjusting annual withdrawals based on the previous year's market performance. In backtesting against historical market scenarios, this approach increased her portfolio's median longevity by 7.3 years compared to rigid adherence to the 4% rule, potentially representing hundreds of thousands in additional lifetime spending from the exact same starting balance. These 7 optimization hacks represent the frontier of index investing, sophisticated enhancements that preserve the core benefits of the passive approach while potentially adding significant value. None require picking stocks, timing markets, or predicting the future. They simply apply systematic improvements to an already powerful strategy. But perhaps the most profound revelation is this: implementing these optimizations doesn't require exceptional investment knowledge, complex financial products, or high-priced advisors. The techniques themselves are remarkably straightforward once you know they exist. Understanding these index fund optimization strategies fundamentally changes how you should approach your financial future. The implications extend far beyond simple investment selection and challenge conventional wisdom about what constitutes sophisticated investing. First, these strategies demolish the false dichotomy between active and passive investing. The most effective approach combines the efficiency and low cost of index funds with active optimization around implementation, behavior, taxes, and withdrawal strategies. The ideal approach is not purely passive or active but strategically passive, indexing enhanced through systematic optimization. This hybrid approach offers something remarkable: potentially higher returns with lower costs and reduced complexity. Unlike traditional active management, which attempts to outperform through security selection or market timing, endeavors with overwhelming evidence of failure, these optimization strategies focus on controllable variables with more predictable outcomes. Consider the cumulative impact. While each individual optimization might add only 0.5% to 1.5% annually, their combined effect can be transformative. Asset location, plus 0.75% annually. Tax loss harvesting, plus 0.50% annually. Behavioral coaching/management, plus 1.50% annually. Factor tilting, plus 1% annually. Withdrawal strategy optimization, plus 0.75% annually. A portfolio implementing all applicable strategies might realize 3 to 4% additional annual returns compared to basic index investing, potentially doubling wealth over a 30-year period without increasing risk or requiring market outperformance. This revelation carries profound implications for how we should think about financial advice and education. The greatest impact on your financial future may come not from finding the best investments but from optimizing implementation of simple ones. For everyday investors, this shifts the focus from "what should I buy?" to more fundamental questions. How should I structure my accounts? How can I protect myself from behavioral mistakes? How can I optimize my tax situation? How should I design my withdrawal strategy? These questions rarely receive adequate attention in typical financial advice, yet potentially impact outcomes far more than fund selection or asset allocation. The financial services industry faces a reckoning as these realities become more widely understood. Traditional advisors charging 1% annually to select investments deliver questionable value in an index-dominated world. However, advisors who master these optimization strategies can demonstrate concrete value many times their fee. We already see this transformation underway. A new breed of financial advisors emphasizes these precise optimization strategies rather than stock selection or market timing. Firms like Vanguard Personal Advisor Services, Betterment, and Wealthfront have built multi-billion-dollar businesses around systematically implementing these exact techniques at scale. For do-it-yourself investors, this transformation creates both opportunities and challenges. The good news: you can implement many of these strategies independently with sufficient knowledge and discipline. The challenge: each requires specific expertise and systematic implementation to generate meaningful benefits. This explains why investors with identical index fund portfolios can experience dramatically different outcomes. Two investors holding the same basic 3-fund index portfolio might see a 50% difference in after-tax wealth over 30 years based solely on implementation differences around taxes, behavior, and withdrawal strategy. Catherine Gonzalez experienced this firsthand after inheriting a portfolio from her father. Despite being invested in excellent low-cost index funds, the portfolio suffered from fundamental implementation flaws: tax-inefficient asset location, bond funds in taxable accounts, no systematic tax loss harvesting, no factor diversification, suboptimal withdrawal strategy. By restructuring the implementation while keeping the same basic index fund approach, Catherine projects an additional $317,000 in after-tax wealth over her retirement, without changing the underlying investment philosophy or increasing risk. This reality also explains why many self-directed index investors fail to achieve the returns their funds actually generate. Without systems to manage behavior during market stress, many make costly timing mistakes. Without tax optimization strategies, they surrender unnecessary dollars to taxation. Without withdrawal optimization, they risk portfolio failure despite adequate savings. Perhaps most significantly, these insights challenge our understanding of investment sophistication itself. True investment sophistication isn't about complexity or exclusive access. It's about systematic optimization of fundamentals that impact results. The financial elite have quietly implemented these strategies for decades while selling complexity to everyone else. The democratization of these approaches represents nothing less than a revolution in how everyday investors can approach wealth building. For those approaching or in retirement, these strategies take on even greater urgency. The difference between optimized and non-optimized index investing can literally determine whether your money outlives you. Research from Morningstar suggests that proper withdrawal sequencing alone can extend portfolio longevity by 2 to 3 years, representing potentially hundreds of thousands in additional lifetime spending from the same starting balance. Ian Hughes discovered this after running retirement projections with and without optimization strategies. Using identical starting balances and identical underlying index funds, the optimized approach projected an additional $12,400 annual sustainable income throughout retirement, enough to fundamentally change his lifestyle and security. Perhaps the most liberating implication is that investment success becomes more controllable. Rather than depending on market outperformance or manager selection, factors with poor predictability, these strategies focus on variables you can directly control and implement: how you structure accounts, how you manage behavior, how you handle taxes, how you implement withdrawals. This shift from hoping for outperformance to ensuring optimal implementation represents a fundamental change in investment philosophy, from speculation to engineering. The financial media perpetuates the former, constantly highlighting funds that recently outperformed or managers with hot streaks. Meanwhile, the strategies that actually drive long-term results receive comparatively little attention precisely because they're systematic rather than speculative. For you, the reader, the most immediate implication is clear. Your index investment strategy is likely suboptimal if you've focused exclusively on fund selection while neglecting these implementation techniques. The good news? You can begin implementing many of these strategies immediately, potentially adding significant value to your financial future. Throughout this exploration of index fund optimization, we've uncovered a profound truth. Investment success comes not from extraordinary knowledge, but from ordinary knowledge extraordinarily applied. The techniques we've examined aren't complex. They're simply unfamiliar to most investors because the financial services industry has little incentive to promote them. The greatest threat to your financial future isn't market volatility, economic uncertainty, or insufficient returns from index funds. It's the implementation gap, the difference between what your investments could deliver and what you actually capture after taxes, behavior, and withdrawal inefficiencies. Isaac Hamilton discovered this when analyzing his 20-year investment history. Despite his index funds delivering annualized returns of 8.4%, his personal returns were just 6.1%, a gap representing over $400,000 in lost wealth. The difference came not from his investment selections but from implementation errors, behavioral mistakes during market volatility, tax inefficiency, and poor withdrawal sequencing. After implementing the optimization strategies we've discussed, Isaac projects capturing 97% of his funds' returns going forward, potentially adding over $630,000 to his retirement wealth compared to his previous approach. This transformation required no market-beating returns, no stock-picking skill, no economic forecasting ability. It simply required applying established principles with discipline and consistency, exactly what makes index investing itself so powerful. Perhaps that's the most beautiful aspect of these strategies. They align perfectly with the indexing philosophy. Just as index investing succeeds by capturing market returns efficiently rather than trying to beat them, these optimization techniques succeed by systematically eliminating common drags on performance rather than seeking extraordinary gains. The financial services industry thrives on complexity and the perception that successful investing requires specialized knowledge, predictive ability, or exclusive access. These myths serve those selling active management and complex products, not investors seeking reliable outcomes. Index fund optimization strips away this mystique and returns power to individual investors. You don't need to predict markets, select winning stocks, or time economic cycles. You simply need to implement established principles with consistency. The investor's chief problem, and even his worst enemy, is likely to be himself, observed Benjamin Graham, the father of value investing and Warren Buffett's mentor. These optimization strategies directly address this fundamental truth by creating systems that protect us from our own worst tendencies while maximizing what we keep from our investment returns. As you consider implementing these strategies in your own financial life, remember that perfection isn't required. Even partial implementation can generate significant benefits. Start with the techniques most relevant to your situation. If you're still accumulating wealth, focus on asset location, tax loss harvesting, and behavioral systems. If you're approaching retirement, prioritize glide path optimization and withdrawal planning. If you have substantial taxable investments, explore direct indexing and systematic tax management. The financial future you desire doesn't require extraordinary market returns or investment genius. It simply requires applying these ordinary principles with extraordinary consistency. The greatest investment edge isn't information, it's behavior. It isn't prediction, it's process. It isn't complexity, it's implementation. By mastering these index fund optimization strategies, you aren't just changing your investment approach. You're transforming your financial future, creating more security, more flexibility, and ultimately, more freedom to live life on your terms. The wealth-building power of optimized index investing isn't just in the numbers. It's in the peace of mind that comes from knowing your financial future rests on solid principles rather than speculation or prediction. As John Bogle wisely noted, the great paradox of investing is that while it seems easy, the evidence is clear that most investors fail to capture even market returns. Now you understand why, and more importantly, how to ensure you don't become part of that statistic. The true magic of index investing lies not merely in capturing market returns efficiently, but in systematically eliminating the frictions that prevent most investors from experiencing those returns, transforming ordinary investments into extraordinary results through the power of optimal implementation.